Hi guys, it's Doc Curry, and now that the banks have been bailed out, the next major market mover is going to be the FOMC meeting next week. All eyes are on the Fed trying to figure out how much they're going to raise interest rates by, and I might just have the answer for you. So let's get into it. Before we get into the predictions for the FOMC meeting next week, let's talk about the news that's moving the markets this week. On Monday, the Dow Jones fell for a fifth day in a row despite emergency backstops, basically bailouts, of Silicon Valley Bank and Signature Bank. Oh, sorry, these are not bank bailouts. I forgot President Biden came out today and he said that the bailouts are not bailouts because we are not in 2008. I forgot that we were redefining the word bailout. We are not bailing out the banks. It's something else. I don't know what you would call it, but it's not a bailout, okay? We're redefining that word, just like we redefined the word recession last year. We're redefining bailouts. So don't call it a bailout, even though it is. Now, back to the stock market. The reason that we fell today, even though we got really good news of the bank bailouts, or whatever you want to call them, is because there's still a lot of fear in the markets that more banks are going to collapse. And actually, the extreme fear gauge that we are in dropped further into extreme fear on Monday. And it was First Republic Bank that led the rout in bank stocks despite the emergency measures put in place by the FDIC, the Treasury, and the Federal Reserve. First Republic Bank shares fell as much as 78% on Monday before recovering much of that and finishing the day down just 53%. By the way, shares of FRC continue to rise in the after hours, and we're up almost 10% as of the recording of this video. After trying to calm depositors yesterday and stop a bank run, First Republic told CNBC on Monday that the bank is not seeing that many depositors leave. Meanwhile, shares of Charles Schwab had dropped 11% on Monday, but then rallied off of the lows after Charles Schwab also defended their financial position. Charles Schwab was taking hits along with other financial firms who had massive bond holdings of longer maturities. Remember, it was the longer dated bonds, both in mortgage-backed securities as well as treasuries, that caused the ultimate demise of both Silicon Valley Bank and Signature Bank. Now, I'm going to get into a little bit more details on the Signature Bank collapse a little bit later in this video. But first, I just want you to know that any bank that had a large number of long-term bonds is currently sitting on a massive amount of losses. And so long as there's not a bank run on that stock, everything's fine because they're going to hold those till maturity. They're still going to make money. But if there is a bank run and if the bank is forced to sell those long-term bonds, they will be forced to sell them at a steep discount, perhaps only 75 to 80 cents on the dollar. And as a result, they will incur significant losses. And if those losses mount enough, it could cause the bank to collapse. And that was the fear around First Republic on Monday, is that they were going to be next. Now, JP Morgan stock paired their early losses to 5% Monday. It actually had climbed 2.5% on Friday and climbed again on Monday. It was one of the day's few banking bright spots. Now, if you watched yesterday's video, you might recall how in 2008, it was JP Morgan Chase who bought Bear Stearns. And when they bought Bear Stearns, that caused a lot of confidence to come back into JP Morgan because people felt like if they were in a good enough financial position to buy Bear Stearns, then they must be secure. And back in 2008, when they bought Bear Stearns, JP Morgan stock rose 8% on that Monday. Now we are seeing JP Morgan stock rise again on this Monday, relatively, compared to all of the other banking stocks. That's because on Sunday, First Republic Bank secured additional liquidity from the Federal Reserve Bank and JP Morgan to shore up its operations. As I said yesterday, it's a repeat of 2008. In 2008, JP Morgan bought Bear Stearns and their stock rallied. Here in 2023, JP Morgan has given money to First Republic and JP Morgan stock has relatively rallied. Now, in the wake of the Silicon Valley Bank failure, Wall Street analysts are making big calls on bank stocks, and boy, are they bullish. As First Republic stock tanked, JP Morgan said buy. Well, that one kind of makes sense. I mean, they just invested into First Republic. They probably want to see a good return on their investment. That kind of makes sense they would say buy. I'm going to pass on taking any credibility on that one because there's definitely an ulterior motive. But some of the others are a little bit more legit. Wells Fargo says JP Morgan stock is a fortress investment in banking. And Citi defended Charles Schwab stock. Across the board, it was a mountain of bullish calls from analysts on bank stocks. And I gotta tell you, I agree with them. After the massive sell-off in bank stocks over the last 3 days, I bought bank stocks on Monday. I bought JP Morgan Chase shares and call options. I also bought calls and shares in both FAC, which is a 3 times leveraged bank ETF, as well as a smaller regional bank 3 times leveraged ETF. I went very bullish on bank stocks on Monday. I personally believe that this major sell-off that we've had over the past 3 days is just providing a once-in-a-lifetime opportunity to load up on bank stocks at extreme discounts. Now, had this been 2008, I probably would not have. But for the time being, I'm ultra bullish on bank stocks because the federal government has come out and they're basically said unlimited bailouts, unlimited FDIC insurance, unlimited bailouts. There's literally no reason not to buy bank stocks right now unless you think the federal government is going to flip and stop bailing out banks. So long as you think the federal government is going to hold tight and bail out every single bank that gets close to collapsing, I think bank stocks are a great buy right now. Now, I want to be clear that this is not financial advice. Nothing I say is a recommendation to buy, sell, or hold any asset. These are just my opinions, and I'm just letting you know what I am doing. Now, in addition to bailing out Silicon Valley Bank with an unlimited FDIC insurance, the FDIC is also planning another Silicon Valley Bank auction. The auction comes after a failed attempt to find a suitor on Sunday. While none of the largest U.S. banks bid on SVB during a failed auction on Sunday, at least one offer was made by another institution, but it was declined by the FDIC. I wonder who that institution might have been. Now, in yesterday's video, I went into a little bit of detail about why Silicon Valley Bank was seized by the FDIC, but I didn't go into detail on why Signature Bank was seized by regulators because it was breaking news and I just didn't have a lot of information. But now we do. So let's talk about why regulators seized Signature Bank and what ended up being the third largest bank failure in U.S. history. We get our information from the Signature Bank board member and former U.S. Representative Barney Frank. He said that the sudden move shocked executives of Signature Bank. Frank said, "We had no indication of problems until we got a deposit run late Friday," that's a bank run, "which was purely contagion from SVB or Silicon Valley Bank." As waves of concern spread late last week, Signature customers moved deposits to bigger banks, including JP Morgan Chase and Citigroup. According to Frank, Signature executives explored all avenues to shore up its situation, including finding more capital and gauging interest from potential acquirers. This sounds identical to what Silicon Valley Bank went through. At first, they tried to get more capital to shore up their balance sheet. When that failed, they tried to find a buyer. And when that failed, regulators took them over. And it looks like at Signature Bank, it was 100% identical, the exact same thing. A bank run caused massive losses. They tried to find more assets. They were unable to. When they couldn't get more money, they tried to find a buyer. When they were unable to, the regulators took them over. Tick for tack, the exact same story as Silicon Valley Bank. Now, what makes First Republic so different from Silicon Valley Bank and Signature Bank is simply the fact that they were able to find additional funding. That's it. That's the only difference. Had First Republic not been able to find additional funding, they would be in the same boat that SVB and Signature Bank are currently in. But because they were able to find additional funding from JP Morgan Chase, they are now fine. And I do expect FRC stock to skyrocket and get back up to levels, probably not back up to where it was, say, on Wednesday, but maybe about 80% of the way there. And just like SVB, regulators are now conducting a sales process for Signature Bank while guaranteeing that customers will have access to deposits and service will continue uninterrupted. Now, in the midst of the banking crisis and despite a shutdown of crypto-friendly Signature Bank, cryptocurrencies have rallied with Bitcoin breaking above 24,000. Now, this might sound a little bit peculiar because a lot of the fundamentals around Bitcoin have absolutely fallen apart over the last few months, with multiple crypto lenders going out of business, banks that are friendly to cryptocurrency going out of business, as well as a whole slew of other things with a whole bunch of cryptocurrency exchanges going under as well. And it seems like, from a fundamental standpoint, that cryptocurrencies should be absolutely tanking right now. But they're not. They're rallying. Why? Well, for the longest time, there has been a belief that cryptocurrencies were kind of like gold or silver, where they were a safe haven from this very risky US dollar, very risky banking system. Yet, for many, many years, despite that being the belief, the reality was cryptocurrency followed along with the stock market. As the stock market went up, it went up. As the stock market went down, it went down. So it seemed like cryptocurrency was way more of a trading instrument rather than an actual safe haven from some sort of collapse in the dollar or other currencies around the world. However, now it looks like that belief that cryptocurrency is a safe haven from a collapse in the dollar is finally true and finally accurate. As the major fears around banks in the United States spread throughout the world, people started pulling their money out of the stock market in droves. They put their money into treasuries and they put their money into cryptocurrencies. And that is why we are seeing cryptocurrency skyrocket right now, because finally this belief that cryptocurrency is the safe haven has finally come true. And just like cryptocurrencies are rising, treasury yields are dropping as treasury prices skyrocket as well. In fact, so much money has been dumped into treasuries over the last 3 days that the 2-year treasury yield just posted its biggest 3-day decline since the aftermath of the 1987 Black Monday stock crash. That was the day the stock market fell 27% in a single day, and now treasury yields have tanked as tons and tons of money has been dumped into treasuries over the past few days. In fact, so much money has gone into treasuries that treasury yields dropped at the fastest pace since the Black Monday market crash of 1987. Now that all of the dust is starting to settle from these bank collapses, the market is shifting its focus to the Federal Reserve. And right now, Wall Street is split on the Fed's next move as the financial sector completely falls apart after these bank failures. Now, generally, during rate increase cycles, the Federal Reserve will continue to raise rates until something breaks. Well, something broke, but the Fed is still expected to go through with rate hikes. So why? Why would the Fed raise rates when the banks are going under because the Fed raised rates? This just doesn't seem to make sense. Well, remember, the Fed is stuck. The Fed has completely lost control of the U.S. economy. The problem is, if the Fed does not raise rates, and especially if they start cutting rates, inflation is going to skyrocket. On the other hand, if the Fed keeps raising rates, more banks are going to collapse. So the Fed is screwed. No matter what they do, the Fed is screwed. And this is why analysts are so torn over what the Fed is going to do next week. Jeffrey Gundlach says the Fed is going to raise interest rates next week to save credibility, but they really shouldn't. And Altimeter's Gerstner says that the Silicon Valley Bank crisis shows that the Fed needs to slow down or a lot more stuff is going to break. And I love the title of this article from the Wall Street Journal. It says, "The Fed's magical accounting might save the banks, but it will doom rate increases." The question everybody wants to know is, will the Fed have to pull back from rate rises? Past rate cycles frequently led to major financial problems that forced the Fed to reverse course. Correction on that. Every single time the Fed has raised interest rates, it has caused financial problems. Of the last 12 times the Fed has raised interest rates, we have had 12 recessions. 100% of the time when the Fed raises interest rates, it causes financial problems. This time, though, the Fed has a bigger problem with inflation. This time, inflation remains far above the target, and the jobs market is still tight. And until last week's bank collapse, the Federal Reserve's Chairman Jerome Powell was talking up the need for higher rates for longer. In fact, up until Wednesday, the CME futures were pricing in an 80% chance of the Federal Reserve doing a 50 basis point rate hike at their next meeting next week. But after the banks collapsed, look where we are today. There's now a 0% chance of a 50 basis point rate hike and a 68% chance of a 25 basis point rate hike. And look at this. This wasn't even on the radar last week. A 32% chance of the Fed pausing and not doing a rate hike. So what do you think the Fed is going to do? Are they going to raise rates by 25 points? 50 points? Are they going to pause their rate hikes because the economy is starting to fall apart? Or do you think they're going to do what Nomura thinks they're going to do and actually cut rates by 25 basis points next week? Let me know in the comments below what you think. Now, as we shift our eyes to the Federal Reserve next week, it's important to understand that even though inflation remains high, the economy continues to slow down. It's not just banks that are in trouble. GitLab lost 1/3 of their stock value after the software company issued weak revenue forecast. And United Airlines also fell on weak earnings and weak forward guidance as well. So the fact is that the economy is getting weaker. Aside from the strong labor market, I know the job market is strong, but aside from that, the whole rest of the economy is getting weaker, it's slowing down. We're entering recession. So what is the Fed going to do? Are they going to focus on raising interest rates to get inflation down, or are they going to stop raising interest rates because it's very, very clear that we cannot handle higher interest rates anymore as an economy? And we might get a little bit more insight into what the Fed might do next week on Tuesday at 8:30 a.m. or about an hour before the market opens when we get the Consumer Price Index, or CPI. Now, this is widely expected to have remained flat month over month while declining year over year. Now, nobody knows what is going to happen tomorrow with the CPI report, but one thing that is clear, one thing we do know for sure, no matter what this CPI report says, the market is expected to move massively on Tuesday. We are expecting a pretty significant move either up or down in the stock market on Tuesday. And we actually opened some condors on the stock market on Tuesday. If you're not sure what a condor is, it's essentially two vertical spreads where we're able to make money whether the market goes up or down. It doesn't matter. We make money either way. It's a little bit safer than a straddle option strategy because on a straddle option strategy, you need that implied volatility to be quite low. And on a straddle, you need a major move in the market up or down in order to make money. We didn't want to do that because the implied volatility in options is very, very high right now with all of these bank collapses. So instead of doing a straddle where you just buy a call and buy a put and hope you get a major market move, we instead did a condor. And the condor, we only need the S&P to move 0.4% on Tuesday in order for us to make money. So long as the S&P moves up or down more than 0.4%, we are going to make money on our condor. Now, if you want to know what kind of trades we're making and how to do these option plays so that you can make money no matter whether the market goes up or down or even trades flat, then come join us in the We Profit Day and Night coaching program. In there, I will teach you how to do these options trades. I will teach you how to do these more complicated option trades, such as these condors, and we can all make money together. I made almost $20,000 today on my VIX calls that I had bought last week, and as well as some that I had bought a few weeks ago. And I know I was a week late on that call out for the VIX going up. I was 1 week late, but it did happen. The analysis was correct, and I made about a $20,000 profit today on those calls. So if you want to know what we're doing and how we make money, and you want to join us in making money with us, then come join us in the We Profit Day and Night coaching program. You can get more information on that by scheduling a call with my onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video with your friends and family and on your social media pages so that your friends and family and all of your social media followers can know what's happening in the market as well. And don't forget to hit the like button and subscribe. And if you missed my video yesterday where I went into great detail explaining everything that's going on with these bank collapses and how all of this compares to 2008, make sure you go watch the last video that I uploaded here.